Good afternoon, everyone, and welcome to Let's Talk Business. Today's subject is Finance for Small Business, and it's brought to you by the Washington Center for Women in Business and in partnership with the U.S. Small Business Administration. Little housekeeping before we begin. This webinar is being recorded. Please mute yourself. Audio, you can use phone or computer. And if you have questions, you can raise your hands or you can type your questions into the chat box, and I will share those with our guest speaker as we go along, and he can decide if he wants to answering then or wait till the end of the webinar. So what is the WCWB? It's the Washington Center for Women in Business. It is an SBA Women's Business Center. We assist Washington State businesses, potential startups in reaching your goals. We help with startup planning, business growth and strategic strategies, business and marketing plans, legal requirements, operations, marketing and sales, motivation and accountability. We provide these services through one-on-one coaching sessions, workshops and seminars, multi-session trainings, and also online, in the phone, and in person. We have our first session that you can have with our coach is free, and then it's $25 session thereafter. We do have some scholarships that are available. You can contact our program manager, Tracy Hansen, and we cover the entire state of Washington. Our staff are Tracy Hansen, Christine Buckley, a business coach, and Ryan Norsgaard is our office coordinator. And today, my name is George Sharp, and I'm hosting today Let's Talk Business. Today, we are honored to have with us Ben Anderson. Ben Anderson is a licensed certified public accountant in Washington State. He started Olympia CPA PLLC to provide the highest level of personalized tax, accounting, and consulting services to businesses and individuals. Before starting his own practice, he worked for some of the best boutique CPA firms in the region. His accounting work experience includes private industry, government, academia, and public accounting. He is also an accounting instructor at the local colleges in the area. In 2015, he was awarded the Washington Society of CPA's new professional award for passion and commitment to the society and the local Olympia chapter. He is the chair-elect of the WCWB Olympia chapter. He is a member of the American Institute of Certified Public Accountants, the Washington Society of CPAs, and associate member of the Association of Certified Fraud Examiners. Please give a warm welcome to Ben Anderson. Take it away, Ben.
Thanks, George. I appreciate that. What a mouthful, all those associations, but you knocked it out of the park. Today's presentation, I mean, we have a small group here, and so what I did is I put together some really common topics that happen. You know, a lot of times people confuse finance, accounting, and tax as kind of being all the same thing. So if you came today to hear about how to get financing for your small business, I'm the wrong guy for that. But what I can cover today is general accounting and tax topics for small businesses. And feel free to just type in questions and chime in whenever you want. I'm going to go over some basics today: entity selection, payroll taxes, and accounting software. But if you have any specific questions regarding tax or accounting issues that are not covered, just chime in whenever. I really, you know, it's my goal, and I also think the WCWB's goal to provide value in this presentation today. So we can customize this as much or as little. So I think, George, they just use the little chat box to type in their questions, right?
That's correct, Ben. Sorry, I was on mute.
Okay. Oh, yeah, no problem. So, yeah, just type it in. And I'm looking at it, George is looking at that, and no problem in stopping my track. So if we could go to the first slide, please. So, and if the attendees could maybe even just type in, you know, are you currently in business, or are you looking to go into business? I think what I'm going to cover will help both of you, but it'll also give me a good feel for where you're at in the process of being in business. So there are three common entity types that I deal with mostly. The first is the easiest to set up and maintain in Washington State, and it's a sole proprietorship. Sole proprietorships, it's like $25 to form through the Department of Licensing or Department of Revenue with a master business license. They don't provide any legal protection, and in no way do I want to come off as giving legal advice today, but essentially you are your business. And it's the easiest way to get in the game, but sometimes what will happen is a small business owner will go out, they're on a shoestring budget and they're trying to do everything themselves, and they go and they form the wrong business type, and then come tax time, they get hit hard with the taxes because they didn't know what they started or it wasn't the right size. So sole proprietorships are really good for very small businesses, for somebody that wants to not have to do a lot of complex tax or accounting strategy. The next type of entity is a limited liability company. These are LLCs. There's more paperwork that you need to file. You have to file this at the Secretary of the State, and then you have to file your master business license application. And it's about $200 to form an LLC. It does give you, as the name entitles, some liability protection, which of course an attorney can advise you on. But as I'll go into about the tax types here, you can set up a couple different tax strategies. With a sole proprietorship, you could have your own bank account or use your personal bank account, but with an LLC, you definitely have to treat it as a different entity. And I advise that regardless of the structure that you pick. And then the last and probably most complex and most costly to set up is a corporation. And this is an Inc., I-N-C. I say that it's more complex because it requires annual minutes to be taken, officers to be elected, and this about $200 to form. That's what it costs at the Secretary of State to form one of these. If you use an attorney to form this, it can cost several thousand easily. And I think it's good to have a business plan in place so am I going to do $50,000 in revenue? Or am I going to do $500,000 in revenue? Am I going to have financing? Am I going to bring in investors? You don't want to undercreate and you don't want to overcreate your business when you set it up. So any questions? Feel free to chime in. Okay, next slide. Okay, so all of these three forms that we just discussed have different tax filing statuses. So by default, a sole proprietorship, and not by default, you don't get any option. A sole proprietorship is filed on your Form 1040. That's your personal tax return. We all have a Form 1040 to fill out. Some people fill out a 1040A. Some people fill out a 1040EZ. But this will be reported on Schedule C. That'll be your income and expenses. The kicker with a sole proprietorship is you've got your income, let's say $50,000, and then $20,000 in expenses, then you have $30,000 of taxable income. That $30,000 of taxable income is hit with roughly 15% self-employment tax. And I think that's the doozy that really throws off small business owners because, just speaking from a strictly cash sense, you go $50,000 minus 20. I have $30,000 in my pocket. Roughly 15% of that, $4,500, goes in self-employment tax, which is your Social Security and Medicare tax, which if you're going from being an employee working for somebody else, your employer pays half of that 15%, and then they take half of that 15% out of your paycheck. But being self-employed, you're responsible for submitting that tax. And what will happen is you have $30,000 and you spent it all, and then your tax guy says, well, you owe $4,500. And it's like, whoa. And I'm using very small numbers here, but they can be very significant to the small business owner. And then that $30,000, after you take a standard deduction and personal exemptions, will be subject to income tax. And about $30,000, you're probably going to pay a couple grand in income tax. So almost a fifth of that $30,000 is going to go in taxes. So that's $24,000 to live off of a year. Any questions? No, I don't see any questions coming. Okay, so the next, and again, this is the easiest filing, right? And what makes it easy to file is it's not a separate tax form to file. It's all part of one form, Form 1040. And but it still means you have to track your income and expenses. So then you have the limited liability company, or LLC. If you form the LLC and you're the only owner, you're by default taxed as a sole proprietorship. And then just like the scenario I ran, there's no tax difference. You've just created some liability protection for yourself. And in my opinion, you absolutely have to have a separate bank account and maintain, the accounting term is called arm's length transaction. You have to treat that as a separate entity. There's no, using the business bank account to buy groceries with, which you shouldn't do anyways, but it muddies things up. The next thing is, if you go into business with another person with an LLC, you then created what's called a partnership, or Form 1065. I recently did a small partnership where they had a little bit of income. A 1099 came in, and they got from some consulting work that they did, and they didn't know the filing requirements, but that partnership tax return is due March 15th. Well, if you fail to file that tax return on time, the penalty for failure to file your partnership tax return is $195 per month per partner. So when we filed their tax return a couple months late, they owed $1,100, but you can actually do a first-time penalty abatement to get away with that. So you can see as we're going down this list, we're getting more and more complex. Also, generally speaking, the owners of a partnership will be subject to self-employment tax. There are some exceptions to that general rule, but again, you can plan on that. The other thing, okay, cool, I got a question. So just hold on, let me finish my thought there, and then I'll, then if a couple form the business, are they treated as a single owner? Actually, that's perfect. If a married couple form a business, they can treat themselves as single owners. So me and my wife form a sole proprietorship, we can file one Schedule C Form 1040. Me and my wife go into business together with an LLC, we can treat ourselves as one person. Or we can treat ourselves as a partnership. So I hope that answers your question, and if not, feel free to follow that up. And I've seen both, where they want to give mom and pop separate K-1s or not. The other thing to mention here is the partnership tax return is a flow-through. There is no tax due on Form 1065. The net income then flows through to the two owners, and they each get what's called a K-1, and then the K-1 is reported on Schedule E of Form 1040. So Next, we have the corporation. And by default, a corporation is taxed as a C Corp on Form 1120. Corporations are subject to double taxation. Once at the corporate rate, which ranges between 15 and 35%, and then again at the individual rate. So if you have $30,000 worth of taxable income, and these are small numbers, so $30,000 of taxable income at the for a C Corp, and this is the default for an Inc., then it's going to be taxed 15%, and then the remaining balance of that $30,000 can get pushed off as a qualified dividend to the owner, which, depending on their tax bracket, could be taxed at 0%. But if we put an extra zero on the end of that $30,000, and we say we have $300,000 of taxable income, well, a third of that is going to go to corporate tax, and then the other $200,000 is going to come in as what's called a qualified dividend or distribution of profit. And the C Corp can elect to keep the $200,000 or distribute some of it or none of it, and then you'll owe individual tax on that to the max of about 20%. So you could, if you took that whole, you know, that 300,000, roughly half of it could be subject to income tax between the corporate and the individual rate. And also with a C corporation, okay, this is a good question too. What factors go into deciding to do LLC versus C Corp? That's an awesome question. So, and this is where it gets really nuanced. And if we flip back to the prior slide, oh yeah, right there. Keep in mind, and there's many different entities between these, but these are the three most common entities. These are formed at the state level. These exist at the state level. And then the next slide is how they are taxed at the federal level. So by default, a one-member LLC is taxed like a sole proprietorship. A two-member LLC is taxed as a partnership. An Inc. or corporation is taxed as a C Corp. And here's where it gets sexy, per se. An LLC can elect, regardless of the number of, well, not regardless of the number of owners, but generally speaking, an LLC can elect to be taxed, whether it's single member or multiple member, elect to be taxed, making sure that it meets certain qualifications. It can elect to be taxed as a C Corp or an S Corp. So a lot of times people will go into the bank, they come, they meet with me, they form their LLC, we elect S Corp status, and they go down to the bank, and the banker asks them, well, what do you have? And they say, I have an S Corp. There are no S Corps at the state level. This is only at the federal level and only for federal tax purposes. So, and I will get your question, but I want to just hit those nuances. So to properly speak the language, you might say, I own an LLC taxed as an S Corp, or I own a corporation taxed as an S corporation. So then an S corporation, and both a C Corp and an S Corp, you need to also issue yourself a reasonable wage. So an S corporation is reported on Form 1120-S, and of your profits, similar to a C Corp, a portion of them need to be W-2 wages, and then another portion of the net income is a distribution of profits. Whether you distribute it or not, you owe personal federal income tax on that, but it avoids the double taxation and also the SE tax. I could run through an example, but to kind of answer this question, what factors go into deciding LLC versus C Corp? For me, actually all of my clients usually form an LLC or own an LLC that's elected to be taxed as an S Corp because we're trying to avoid the double taxation of a C Corp and the self-employment tax of a sole proprietorship. So, really quick example how this works, and I'm sorry if I don't have a visual. I don't have a visual to show you this, but you can definitely Google it. So, if you have $100,000 of net income with an S Corp, or you have $100,000 worth of profit, you could issue half of it as a wage, $50,000, and then the other half is a distribution of profit. In a sole proprietorship, if you had that, you're going to pay roughly 40% in taxes on that $100,000, 25% income tax, 15% self-employment tax. With the S Corp, you're going to pay still 40% in taxes on the 50%, $50,000, but you're going to avoid self-employment tax of 15% on the other $50,000. So you can never avoid income tax per se, but you can avoid SE tax through strategic planning. It's not the hardest concept to explain. Oh yeah, here. When would you determine that you're doing 50 wage and 50 profit in your tax time filing time? You would consult your accountant and get in sooner rather than later. You really don't want to be essentially making this up at year end. You don't want to come in and I've seen all sorts of scenarios where they come in and they have a bunch of income and they fail to do tax planning, and we've got to set it up for next year. Or they already put themselves on payroll, but they're an LLC, but they never elected S Corp status. So when would you determine you were doing 50 wage and 50 profit? First, I know I used a really simple scenario of 50-50, which is 50% W-2 wage, 50% distribution of profits. First of all, with planning, you would want to meet with your accountant, your CPA, your tax advisor, and determine what is a reasonable compensation. Then you would want to set that up, cash flow pending, determine on cash flow, and then set yourself up on payroll. But sometimes at the end of the year, you don't know that you've made that much money until the end of the year. Things can also be seasonal too. So I would do that as soon as possible. So LLCs, great question. LLCs are essentially what's called a disregarded entity. There's no LLC tax form. It's either taxed as a sole proprietorship or taxed as a C and an S Corp. As a sole proprietorship, you're going to be on calendar year, or your LLC, you could elect to be taxed as a C Corp or an S Corp, and that's when you could determine another year. Honestly, I personally despise fiscal years. So my recommendation is to just keep everything on calendar year. So I think, let me just scroll here. I think I got everybody's stuff. All right, let's do the next slide. Okay. All right, so accounting software. How are we going to track all this stuff? So my biggest piece of advice today to a small business owner, to any small business owner, always, especially starting out, is open up a business bank account. I don't care what entity type you are, even a sole proprietorship. Even if you can legally use your personal bank account, open up a business bank account and use it. Meaning all cash in, all cash out go through that bank account, because the bank account will allow you to download those transactions or link them to a piece of accounting software like QuickBooks Online, and it will take care of a lot of the manual data entry, which is the date of the transaction, who it went to, and how much it was for. which the only thing left to code is what account. Was it meals and entertainment? Was it office supplies? Was it auto? Was it marketing? But what I see a lot of times is they open up the business bank account, but they don't have any funding, so they take out credit cards personally. And you just use whatever credit card you have a balance on. So at the end of the year, the client comes in, they've got the business bank account, but they also paid for things personally, and they also have 3 credit cards they use, 3 personal credit cards they use to finance the business. Oh, and by the way, whatever they had at the time, they also commingled personal expenses on those credit cards. That creates an accounting nightmare at the end of the year, because you have to separate out all those transactions. And you may not want to import them all, or put, you might not want to put three credit cards on there with $50,000 of transactions, and half are business and half are personal. So my recommendation is get a bank account, use it, and if you have to get a credit card, get a business credit card. And then the next kind of question is, in picking your software, is, do you need to create invoices? And will you be charging sales tax? So, because this is a biggie, and it's probably one of the biggest compliance issues being a small business owner. I have a client that does alteration and clothing, and all of that is subject to sales tax. And if they provide the service at their shop, which is currently out of their home, they're subject to sales tax there. But if they open up an online website and start shipping all over the state and the United States, they'll need to collect sales tax where the sale occurs. And the Department of Revenue has said the sale occurs where the customer is sitting. Think Amazon. So if I'm sitting at my home in Olympia and I buy something from them in Bellingham, they don't charge Bellingham sales tax, they charge Olympia sales tax. And that sales tax, so they sell something for $10, but they have to collect 89 cents on that, so they collect $10.89. They have that cash, that 89 cents, but they shouldn't spend it because it's a trust fund tax, and they're going to owe that to the state, either monthly, quarterly, or annually. So usually if you need to create invoices and you need to charge sales tax, this also goes for service businesses. A landscaper could have clients in Olympia, Tumwater, Lacey, Rochester, Chehalis, Centralia, Shelton, and they have to charge sales tax at all those places that they provide those services. So usually the need to have invoices and charge sales tax requires a bigger accounting system than an Excel spreadsheet, versus a small consultant might only need their bank feed from their bank account and an Excel spreadsheet. So kind of what's most popular for accounting software, if you're need to create invoice and need to charge sales tax, because you're going to need to track all those. The 2 most popular brands out there that I'm used to using, I don't make any money by suggesting these, but it's QuickBooks Online and QuickBooks Desktop. QuickBooks Online is going to fit most small businesses that don't require advanced reporting. QuickBooks Online just doesn't have the reporting yet. QuickBooks Online also will link up with your bank account and also your credit card account. Is there anybody on the webinar that currently uses QuickBooks Online? Anybody want to type that into the little chat box, like, yes, I use QuickBooks Online and it's wonderful, or yes? Okay, So I don't know who's doing your bookkeeping for you, but a lot of my small business owners go and they get QuickBooks Online because it's a great do-it-yourselfer program. And they, yeah, $40 a month fee. Yeah, it's $40 a month. You know, talking about cost for a second, you could get QuickBooks Desktop for $300 and it'll be good for a couple of years. So let's say we got $300 divided by 24 months, that's $12.50 a month. It's hosted on your machine, and then you have to exchange backup or accountant's copies with your accountant or bookkeeper, versus QuickBooks Online kind of gives you, lets everybody access your information, meaning your accountant, your tax person, you, an employee. And a lot of times I ask my clients, are you reconciling your bank statement? And they think matching transactions and adding transactions from their bank feed is reconciling, because I think that's actually what QuickBooks Online calls that. And that's not actually reconciling. And unless you become a ninja at this, what will happen is you will create a lot of double posting errors by just, you know, and I hate to use this word, I don't mean any bad term in this, but because I think we can all be mindless at times, but mindlessly accepting those transactions, adding transactions, adding transactions, adding transactions. If you're creating invoices and then adding those deposits, you're actually double booking your income. So what I'll find at the end of the year is a bank statement that's overstated by double. Like, let's say the bank account says there should be $2,000 at the end of the year, and there's $4,000, and I'll see that sales are twice as much as the deposits because they've double booked it. Honestly, even though, you know, I think there's a lot of advantage to using the bank feed, one of the best things you can do for yourself is turn off the bank feed and manually enter your transactions so you can learn your accounting software, or pay a really good bookkeeper or accountant to do your books for you. And what we do is we train you to use your invoicing correctly, because you need to be out there making sales and collecting the proper amount of sales tax. The other recommendation I have is set up your sales taxes by code. Don't think of Olympia as Olympia. I was in Olympia cutting lawns. No, I'm in code 343 because I live right outside the city limit. I'm actually like code 3400, which is still Olympia, but it's a different tax rate. I think Thurston County alone might have a half a dozen different tax rates. So get in the mindset. And actually, DOR has a really great app that you can download on your phone. I forget what it's called. I'm going to look at my phone. It's called Washington Sales Tax, and it will actually use your GPS and tell you right where you're at and what code to use. So when we set up a new QuickBooks Online or even QuickBooks Desktop account client, we make sure that their sales tax feature is right and that they're charging the appropriate amount of sales tax. My other recommendation is that in either feature, QuickBooks Online or QuickBooks Desktop, you do not use the pay bill feature where you enter a bill and then you pay a bill. Usually a lot of small business owners are paying their bills on time and they don't need to know what's outstanding. They just keep it in a pile and then they write checks every couple of weeks to pay those bills. So turn off the pay bill feature and probably turn off the bank feed on QuickBooks Online, or get really good training. I've become a master at fixing QuickBooks Online mistakes. And then QuickBooks Desktop, I think, is for clients that are bigger, you know, probably several million in revenue, multiple locations. They want budget versus actual reporting. It provides better metrics than QuickBooks Online does. But a lot of my clients are on QuickBooks Online. And both have a payroll feature as well. So that $40 a month, I don't think includes payroll, but you might end up paying an extra $20 a month, where QuickBooks Desktop, you buy Desktop for $300, but then you have to buy payroll enhancement for like $200, and that's annual because of the annual payroll tax changes. I think that's about. Any questions on accounting software? Okay, well, chime in whenever. So what are the taxes associated with a small business? You already have federal income tax. Again, if you're a C Corp, you're going to have a separate corporate tax rate, and then everybody else gets hit with federal income tax. The next is the self-employment tax. It's 15.3%, and that's Social Security and Medicare, and that's for sole proprietorships. But if you're a C or an S Corp, you will also be paying that tax as an employee. Your business will pay half of it, which whatever the business pays, you're paying. And then you as an employee, half of that will come out of your paycheck. Everybody always uses this general term, quarterlies. What are my quarterlies? So sometimes they think estimated tax payments are quarterly. Estimated tax payments are for your federal income tax and your self-employment tax if you're a sole proprietorship and you're not on payroll for your company, because really your payroll should be covering definitely your W-2 wage and some distribution of profits, or maybe you should be accounting for that. Estimated tax payments are due in April, June, September, and then January 15th. It's not quarterly like April 15th, July 15th, October 15th, January 15th. Is actually kind of funny. It's like April 15th, June 15th, September 15th, and then January 15th. And that is what estimated tax payments are, is when you were an employee working for somebody else, they were taking out your federal income tax and your Social Security and Medicare tax with every paycheck. Versus now you're on your own, you get all the money, nobody's withholding the taxes for you, so you should be making estimated tax payments. What happens if you don't? If you don't make estimated tax payments, you're hit with 4% annual applied quarterly. So if you miss Q1, and let's say your total tax bill was 10 grand at the end of the year, and you should have paid quarterly, 2,500, 2,500, 2,500, 2,500. So it's really like 4% on the first 2,500, 3/4 of 4% on the second 2,500, 2/4 on the third, and then 1/4 on the last one. It's probably the smallest penalty for not making that. And some of my clients opt to pay it all at the end of the year, and some of my clients absolutely don't want to get dinged with a penalty, so they want those estimated tax payments dialed in. And then another one that people are kind of unaware of when they go into business is the Washington State, I call them DOR taxes, but it's technically called a combined excise tax return. And that could be based on what your revenue numbers are and whether you have to collect and remit sales tax. Could be filed monthly, quarterly, or annual. And the first tax is a B&O tax, and then the second tax is sales tax. So B&O tax, that's a business expense, and it's on your gross. So if you have $100,000 gross and you're a service business like myself, that tax is 1.5%. They have a small business credit for the first $50,000 of gross revenue. So a lot of clients, if they're under $50,000, they owe nothing. That being said, you could be under $50,000 and have to collect sales tax, so you need to collect and remit the sales tax. And remember, that sales tax is other people's money, not yours. So if you have to collect and remit sales tax, my recommendation is to set aside easy 10% of all your deposits so that you cover sales tax, B&O, and a little bit of headway. But if you collect a couple of grand in sales tax in a quarter, you've got kind of this big pot of money in a savings account, and it should be kept in a separate account. And when times are hard, I find people get in trouble by tapping into that because the penalties are pretty harsh for not paying that on time. It goes from 9 to up to 25%. So 9% if you're 1 day late on these. And then the last tax that's reported on these DOR taxes, which kind of catch people off, is what's called use tax. So use tax is anything you buy that you don't resell, that you use in your business, you owe use tax on. So my desk, I bought it off of Craigslist for $300. I didn't pay that person $300. I didn't pay them sales tax when I bought it, but I have to report that on my DOR tax return that I bought something and didn't pay tax on it. Now, if I resell something, you don't have to pay tax on something you resell. Think, again, Amazon purchases, a lot of online purchases, and people can get hit with a DOR audit by not reporting use tax because we almost all have some use tax to report. So when you get an invoice, if you notice there wasn't sales tax on it because you bought it online or you bought it used, file it away for your quarterly or monthly DOR report and then pull that out or give it to your tax preparer. So that was a big mouthful on taxes. Then we have payroll taxes. I think this is what people most commonly refer to as quarterlies. So if you're going to have employees, even if you're going to be the sole employee in an S Corp or a C Corp, you're going to have all these payroll taxes. What about county tax? Good question. What about county tax? County tax is, I call them, it's personal property tax, and that is for property that the business owns. And it also doesn't kind of coincide. Yeah, so personal property tax. Every year, businesses get from Thurston County or Mason County, or if you have multiple locations, you might have a store in Mason County, a store in Pierce County, and a store in Thurston County. Personal property tax is on tangible personal property and most leasehold improvements with some exceptions. So tangible personal property is anything you can pick up and walk out with. You will owe county tax on that, and what they do is they send it out. It's due April 30th, and it's what did you have on the premises, I think, at the beginning of the year, and then they assess tax on that, and then it's due the following year. And then you should also allocate a certain amount to supplies as well. And supplies are not what you're reselling. It's like your pen closet. So I hope that answered your question about county tax. I call that personal property tax, and that's filed with the county.
Ben, if I could interrupt for just a second, I'm not sure on this webinar, I'm getting a timer notice that maybe because you and I signed in at 45, it's going to run out of time in about 3.5 minutes. And so if there's anything specific, and we'll just continue through if it keeps going, but in case we get logged off, that's going to be what happened, and this will be and is recorded and you can see it again. So.
Oh, okay. So here's quarterlies. Again, and good question on the county tax issue. Again, if you do payroll, you're going to, I got a little chime in here, something left, okay. So, and this is pretty much my last slide. Let's just go to my contact page, which is the next slide. I can talk about payroll taxes too. So if you need to get a hold of me, this is me, this is my business. You can email my firm administrator for scheduling or appointments. I don't give free consultations. My rate is $95 an hour. It's not a sales pitch. You don't have to use me, but just some people will call and want to ask me free questions, but I just want to be clear with that. So that's how you can get a hold of me. I'm also at olycpa.com. The previous slide, back to good old payroll taxes. So quarterly, you're going to have Employment Security Department taxes. Probably not if you're the only owner, the only employee on the books. You won't have L&I taxes. The minute you get an employee, you're going to have those two taxes. So give it some thought about whether you're going to hire employees or not, because it can be costly to bring one person on. Minimum wage is also $11 an hour. And remember what you get for $11 an hour. You might have high turnover, and your ESD rate is going to go up on that. And payroll processing. Every time you have to enter a new employee, you have to get the W-4 and the I-9, and you have to file a new hire report with DSHS. Then you have 941 taxes, which is, and I put EE or ER. So ER is employer and EE is employee. Employer taxes, so ESD, you're on the hook for that. That's about 1%, 1.5% of wages up to about $40,000. L&I tax is on the hour for hours worked, and a portion of it is employer tax and a portion of it is employee tax. For like in administrative positions where it's 14 cents an hour, you could take like 2 cents out of the employee's paycheck and you have to pay 12 cents. A lot of times it's a feel good to just pay the tax for them. But again, it's always up to the client whether they want to withhold that or not. And then 941. 941 is the tax return that's filed and due quarterly. But the tax, depending on your size, the EFTPS deposit could be due a week after every payroll, so semi-weekly. It could be due monthly, 15th of the day for the following month, or quarterly, due with the 941. It's going to be, so what will happen is people think they get hit so hard by the 941 tax, but actually, if you have to pay $5,000 in 941 taxes, more than half of it is actually your employees. It's not yours. But it feels weird because you might pay them $3,000 gross, pay them $2,000 net, withhold $1,000. You owe a couple hundred on top of that as well, or like $700. So you can really get yourself in trouble. And I put the bullet point there, trust fund taxes. These are other people's money that you're withholding from their paycheck. Make sure you're managing your cash properly, because one part of my practice is IRS resolution work. And so I also deal with clients that have gotten in trouble for not paying their trust fund taxes. Same with DOR taxes. So you've got ESD tax, L&I tax, 941 taxes. Plus annually you'll have your 940 federal unemployment tax. That's rather a small tax. It's 0.6% on the first $7,000 in wages, so $42 per employee. If you're the sole owner, sole employee owner of your business, in general, you won't be paying state unemployment tax, so you're actually going to owe 6% of $7,000, so $420 in tax on that one. And then that's deposited anytime the liability on a quarterly basis reaches over $500. So usually not a doozy. It's really that 941 that's the big one, and L&I, and then ESD. So I don't think we got kicked off, did we, George?
Oh, but it looks like we're still going.
Okay, good. Any questions? I got some really good questions, so I appreciate that.
Ben, what is the recommendation if somebody wants to get their information together, then to have a conference call with you or to meet in person with you? What do you think they need to do gather up before they come to meet with you?
That's a great question, George. So it really depends what they need. I met with a small consultant the other day. They actually formed their own business. They filed a lot of their own paperwork. They were slugging it through the S Corp election, and they're just like, I know I'm supposed to do all this, just do it. And it's like, great, I'll do that. So if you're going to have us do your DORs, you're going to have us do your payroll, you're going to have us do your tax returns and things like that. Bring in all that beginning paperwork. And a lot of times people either just don't file it, don't hold on to it, but the minute you form a business with Washington State, file a master business license, you're going to get a welcome letter for Department of Revenue Tax. Keep that letter because it has what's on it, a PAC code, and I need that code to put you into my system so I can file your DOR taxes. You're also going to get a welcome letter and a rate notice for ESD if you told them on your master business license you were going to have employees. Same with L&I. Or conversely, if you told them you wouldn't have employees, you're going to get a letter saying, make sure you understand the rules for independent contractors. If you've been filing taxes, usually just 1 year, last year's tax return is good enough. I can kind of see what's going on, if any errors stick out, login information to your bank account, and other important sites. Usually the initial consultation, for me, is a new client info sheet and a signed engagement letter, which articulates my fees, and it opens up the window for us to opens up the door for us to work together. And what I find with professional services is a lot on a as I need you basis thing. So payroll, DORs, accounting, tax returns, they all have deadlines. So we've got them in their system there. Sometimes I have a blended client that wants to get QuickBooks training, so bring in your laptop. Other times, so we'll go over a session, and I never book an appointment for more than 2 hours because, as you can see, just even in an hour, it can be overwhelming. So I usually try to keep them to about hour-long appointments, and then they can follow up with emails and things like that. So it's really kind of just a blend of what they want us to do.
And I think it's really important that you remind people, if they're going to do an LLC or a Corp, the first step that they go through to get their business license is not to go to DOR, but to go and do their Secretary of State, right?
Oh, absolutely. You would form it at the Secretary of State, and then the Secretary of State issues your UBI number, and then you go over to DOR and do the master business license application, because if you don't do that, you could trigger 2 UBI numbers. Or what I see is people, they'll use LegalZoom or something like that. They'll form an LLC at the Secretary of State, but they didn't fill out their master business license application, and they come into me and they need to issue payroll today. Now, we can work with them with that, but it makes things more difficult. The easiest way to clean up a mess is to not make one in the first place.
Ben, do you use a checklist with first-time clients?
I actually don't have I have a checklist for tax preparation, but it really depends what they have me do that I request. So I kind of have like a master list, and then depending on what they're having me do for them or what I'm doing for them, I pick out from that. And it's really customized.
We're kind of coming to the end, so if anybody has any questions that they'd like to put into the chat box right now, otherwise, Ben, if you could give us a wrap-up.
Yeah, really, any questions, even anything we didn't cover, any questions you've wanted to ask a CPA or tax questions.
And again, if you
You
wanted
know,
to reach the Washington Center for Women in Business, you can go to WCWB.org and find all the information about our program.
I can't say enough about the that program there. It's really valuable, and if you're starting a business, to budget that $25, a week into it, just to have somebody to bounce ideas off of. When you compare my rate or other professionals' rate, what you get for that is really exceptional.
Well, Ben, we want to thank you for being on Let's Talk Business, and thank you everyone for attending, and we hope you have a great week.
Thank you, George. Thank you, everyone.